I was fishing last week. They told me they only had steak for bait. I didn't know fish like steak. I got a little sidetracked because I couldn't stop thinking about something that happened earlier this month when Walt Disney reported what I thought was a pretty fantastic quarter on February 5th. Yet the stock sold off down nearly 2.5% the same day. At the time, I figured investors would quickly snap up this one. Oh, come on, they'll buy the dip. In fact, I don't think it even should have been down. But it's now been 2 weeks later, and the stock of Disney still hasn't recovered. So I'm going to break this one down for you. Full disclosure, we've owned Disney for the Charitable Trust since 2018, and during that time, the stock's gone from a huge winner to being a frustrating holding. But I've been willing to stick with it, especially since Bob Iger came back as CEO near the end of 2022. Sure, I threw my support behind Nelson Peltz, the famous activist investor, when he made a run at Disney last spring to get a board seat. I still think the company could have benefited from his advice. Long story short, though, I like Disney's entertainment portfolio and its underappreciated parks business, which is why we've stuck with the stock through years of underperformance. I think we are going to win big on this one, and I am patient. Now, after the proxy fight, this thing started showing signs of life, climbing from 83 and change in August to 118 at the highs last year, largely thanks to a strong quarter in November. By the time we got the next earnings report a couple weeks ago, the stock had pulled back to 113, but it was still looking pretty good. And then the company reported the stock sold off. I think it's crazy. Disney reported a modest revenue beat paired with a major 31-cent earnings trouncing off a $1.45 basis. And that's thanks to very successful cost cuts. Hey, those matter. They still count. The key theme of the quarter was impressive profitability, as all three of Disney's segments beat operating margin expectations. Entertainment, the most important division, had a slight revenue miss, easily explained, and the cost cuts translated into much better than expected operating income. Or just look at the turnaround in their direct-to-consumer business, DTC, which is mostly the Disney Plus streaming platform. This used to be a money pit, constantly burning cash. In the latest quarter, though, it generated $293 million in operating income. That's way ahead of what the analysts were looking for. Why didn't anybody care? Substantial improvement for the previous quarter. Streaming business has now turned a profit in 3 of the past 4 quarters. I'll take it. The next biggest division is experiences. All right. Now, this includes the parks business, the criminally underrated Disney Cruises unit. You know, we had a good special on that. Excellent quarter. A lot of investors were worried the business would be damaged by the hurricane, especially since one of them forced Disney World to close for a couple of days. But no, the experiences division did great with a terrific top and bottom line beat. I love this business. Hey, by the way, show me Netflix's experience division. They don't have it. Meanwhile, there's the smallest segment, sports, which is mostly ESPN. It also had a top and bottom line beat, for heaven's sake. Right now, Disney Sports Division is focused on the upcoming launch of a new flagship ESPN app. It should offer meaningful improvement from the current ESPN Plus streaming platform, although it's probably not coming until next fall. Still, it's nice to see the sports business delivering on profitability expectations ahead of time. Why didn't people focus on that? So if everything was so darn great, why the heck did the stock pull back in response to the quarter? All right, there generally was not much hair on this one. I saw a couple things cited. I mean, first, despite the generally strong results for the reported quarter, Disney didn't raise its full-year forecast for the 2025 fiscal year, reiterating its call for high single-digit adjusted earnings per share growth for the year, approximately $15 billion in cash provided by operations. Would I have liked the guidance hike? Sure. But I'm fine with management being cautious. On the conference call, CFO Hugh Johnson, one of the all-time great finance guys out there, explained that the company felt it would be premature to raise its outlook so early in the year, given the, quote, rapidly evolving, end quote, economic environment. Okay, he's a pro. That's what he should do. By the way, he did a great job for years as CFO of PepsiCo. He's handled this stuff. He knows how to handle it. He knows how to do these calls right. The other source of potential disappointment, Disney Plus subscribers fell from 125.3 million to 124.6 million during the quarter. I didn't like this. That slip in the subscriber count came after Disney put through a $2 price hike in mid-October for most of its subscription plans. So a lot of hammering about it, the fact that hundreds of thousands of people chose to cancel. Now, Disney also had the misfortune of being compared to the aforementioned Netflix, which had just reported that it added a record 19 million subscribers in the same period. That hurt. Again, though, I still feel pretty sanguine about Disney Plus. As we used to say in law school, Netflix is sui generis. It's in a class of its own. Disney Plus will probably never be that good, but it's delivering profitable growth right now, and that's enough for me. It should be for you, too. On the conference call, CEO Bob Iger offered some more encouraging commentary on streaming subscribers, saying that the churn in the quarter was not as bad as management expected given the price hikes. He noted that total streaming subscribers still grew in the quarter, thanks to 1.6 million gaming from Hulu. Disney expects overall subscriber growth for the streaming business this year. That's thanks to a great slate of movie titles, along with their password-sharing crackdown and an improved algorithm to recommend content. Finally, on the weekend after the quarter, there was this really a tough piece in the Wall Street Journal. It was called A High Cost of Disney Vacation. It mentioned that even Disney is worried about the issue. We think that spooks some investors, too, even if it's not exactly breaking news. Still, you don't want to be reading that your tickets cost too much. I come back, though, and I say, if prices are so high, why is the place always packed? Overall, however, I found a lot to like on the conference call. And at that moment, it certainly seemed that Wall Street agreed with me, at least initially. On the day of the report, I was watching closely. Disney opened up more than $2. At one point in early trading, the stock hit a high of $118 and change. That's up nearly 5% from the previous day's close. Then the stock reversed hideously, finishing down that day almost 2.5%, and it has not recovered since. However, after looking into the reasons why people sold Disney after the quarter, I got to tell you, I think the bear case, thin. I'm sticking with my gut that this was an excellent quarter for Disney, and the weakness in the stock since the quarter is indeed a clear buying opportunity, especially if you don't already have position this one. We bought some more last week for the trust, and on Thursday's noon club meeting, I will certainly be pounding the table on this one, too. Right here, the kicker. After this latest pullback, Disney trades at just under 20 times this year's earnings. That's a premier growth stock. It's the cheapest it's been in ages. So here's the bottom line. Disney reported an excellent quarter a couple of weeks ago, but didn't get any credit for it. Mostly because management didn't want to aggressively raise their full-year forecast so early in the year. But the dip here has created a terrific buying opportunity for you, with the stock now trading at bargain levels relative to the kind of valuation it used to get. So you know what? Time to take a page from Jalen Hurts, because we're going to Disney World. Let's take some questions. Let's go to Bill in Massachusetts. Bill!
Jimbo, it's your friend Boston Bill. Happy belated birthday, my friend.
You're terrific for mentioning that, my historic birthday. Thank you very much.
Listen, everything's been doing great. I've been with the club. This is going into our 4th year with the club, and I'm loving it.
Thank you, Bill. I hope you're on our call Thursday. I hope you're on the call Thursday at 12. We'll give him a shout out. All right, thank you.
Absolutely. Your staff's incredible, and I just wanted your opinion on Netflix. It never seems to come down enough to really buy it, but today it came down a little. I wanted to know your opinion. Thank you.
A lot of the momentum stuff. First of all, Bill, thank you for being so loyal. Thank you for remembering the club. I look forward to Thursday's call because I know people who like it. Let me give you the Netflix story. It's skinny very quickly. Every momentum stock came down today. This was an attack on momentum and back into other classic growth stocks. And what an opportunity to buy the stock at Netflix. I do like that company very much. You know from the club that Disney's cheap, but Netflix is sui generis, none like it. Anyway, look, Disney did report an excellent quarter, and the stock shouldn't be down. It's trading at one of the cheapest valuations. I rarely pound the table like this. I think it's probably a time for you to start a position. Hey, much more Mad Monday, including my student with J-Bill. Oh my God, what a stock that is. If it hit a new all-time high last month. Then what should you make of the valuation of some of these decade standout IPOs? I'm breaking down the perspective of the retail investor. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.